Hello, everybody. So today was a big day. Bank of Canada policy meeting this morning at 10 a.m. And as was widely expected, the bank did hike their interest rate 25 basis points to 0.5% now. And again, this is really to address inflation, which everyone's really expecting. A lot of people were expecting this in January. They didn't at that time just because of Omicron closures and lockdowns. However, this time they felt it was necessary to hike. So I'm just going over the statement that they've released this morning, and I'll talk about some points and sort of what my thoughts are around it. Now, my assessment of this, I would classify this as what's called a dovish hike. And that's a term that we used to use in financial markets when I was working there. And I'll explain what that means. So when sort of the tone of a statement or a central banker speaks, when they say something, they're hawkish, they're being hawkish, it means they're sort of talking up interest rates or aggressive path of interest rates rising. And when they say, that was a dovish tone or a dovish statement, it sort of means more conservative or leaning towards sort of rates decreasing. Now, obviously, I'm not saying rates are decreasing; they're at rock bottom, and then now they've kind of been increased by 25 basis points up to 50. But why I say it's a dovish hike are for a couple of reasons. So, one, they had to hike again, had to address inflation. It's a big story. However, the landscape has changed a little bit for them right now, and they have to be a little cautious as to what's going to happen going forward. So, for example, in the first paragraph, they say the bank is continuing its reinvestment phase, keeping its overall holdings of Government of Canada bonds on its balance sheet roughly constant. So that means they have not started quantitative tightening yet. Now, at the last meeting, they did mention that once they start to raise rates, they're going to look to reduce their balance sheet. Now, they didn't at this meeting, and the reason is because they have to keep some stimulus or the same level of stimulus in the market because of new geopolitical risks right now, right? So they address that in the second paragraph right after. The unprovoked invasion of Ukraine by Russia is a major new source of uncertainty. This will add to inflation around the world, and negative impacts on confidence and new supply disruptions could weigh on global growth. So again, it's the uncertainty that the market doesn't like. Obviously, we're seeing an inflationary impact right now with the conflict because oil prices, crude oil barrels now crossed 110 this morning. Now they're hovering just around 109 last time I checked. And they're going to have inflationary pressures on food prices as well. However, now the global risk of the other side, right? What other implications can come out of this that may impact global growth collectively, right? What's going to happen in North America, in Europe. So again, that level of uncertainty now is cause for concern to a certain extent from the central bank. Now, the domestic picture is doing very well, and they do address this as well. So economic growth in Canada was very strong in the fourth quarter of last year at 6.7%. So yesterday, GDP numbers were released for Q4, and it was 6.7%. So again, the Canadian economy is doing very well. It's coming out of the Omicron lockdowns very well. And the government, or sorry, the central bank is very pleased with sort of the progress that's being made. Now, they do talk about the housing market. Housing market activity is more elevated, adding further pressure to house prices. Again, this is one of the major drivers of the inflation story right now, as well as just an affordability issue. A lot of Canadians just can't afford housing right now, or sort of are put in tight spots. And this is creating also a lot of highly leveraged individuals, which also is usually a cause of concern for the central bank. So that was their one line of addressing that, saying it is still an issue. Now, CPI is the biggest cause of concern, which is why they have to sort of raise rates or be on a rising interest rate path. Currently at 5.1%, and it remains well above the bank's target range. Price increases have become more pervasive. So they're directly addressing it there, and they later on in that same paragraph talk about trying to get back to their long run average of 2%, and that they will use all the tools in their toolbox. Now, obviously in the last paragraph is usually a summary paragraph. They talk about the Government Council expects interest rates will need to rise further. Obviously, we're going to be on a rising interest rate path now for the next little while, probably a couple of years at least, until they sort of get inflation story back into their target range. And quantitative tightening would complement increases in the policy interest rate. So going forward, as they start to raise rates, they will also look to reduce balance sheet and let some of those bond maturities roll off and reduce the amount of quantitative um, supply or quantitative easing in the system right now. So that's sort of my thoughts around this. Again, I'm classifying it as a dovish hike. The hikes, however, there's a few points in this statement that are a cause for concern for them. So that's why I'm saying it's a dovish hike. The next meeting will be April 13th. That is an MPR meeting, so we'll hear more from the governing body at that point. But again, Macklem has a meeting tomorrow, so the market will look to see sort of any context he puts in that meeting behind this statement. Okay, so that's everything as usual. If you have any questions, hit me up. Thank you.